9.2%. That is the record default rate for private credit in 2025. And if you don't know what private credit is, don't worry, because by the end of this video, you're going to be very familiar with it, and probably a little bit angry. Fitch puts the trailing 12-month figure at 5.8% through January 2026, which is the highest number in the entire history of their data. Cool, some loans are going bad somewhere. What does that have to do with me? Well, it has everything to do with you, because on March 30th, 2026, the US Department of Labor proposed a rule that would allow this exact asset class. $2 trillion of loans made in the dark, priced by the people who own them, with no public exchange and no daily quotes, directly into your 401k. Not some pension managed by professionals, with actuaries and a team of lawyers who do nothing but read fine print all day. Your retirement account. The one you check on your phone while you're waiting for coffee. To understand how we got here, you need to go back to 2008, which at this point is basically the origin story for every bad financial idea in the modern era. After the financial crisis, regulators forced banks to hold more capital against risky corporate loans. And banks, being banks, did the rational thing and stopped making a lot of those loans. Mid-sized, debt-heavy companies that used to borrow from the big names on Wall Street suddenly found themselves without a lender. And so, as always happens when regulation creates a gap, an entire shadow industry rose to fill it. Asset managers raised funds, lent directly to these companies, kept the loans on their own books, and called the whole thing private credit. No bank regulator, no public market, no daily price discovery. Just a fund manager and a spreadsheet, and a very healthy management fee. For about 15 years, this was genuinely one of the best trades on Wall Street. The market grew from a few $100 billion to roughly $2 trillion by 2026, with industry projections toward $4 trillion by the end of the decade. Pension funds, endowments, and insurance companies piled in because interest rates were at zero, and they needed yield from somewhere. Private corporate pensions now hold about 21% of assets in alternatives. Public pensions are sitting at around 35%. Then in August 2025, the White House issued an executive order directing regulators to open retirement plans to alternative assets, and the Department of Labor followed up in March 2026 with a proposed safe harbor, essentially a documented process that shields whoever manages your company's 401k from legal liability when they add private equity, private credit, real estate, and yes, digital assets to your investment menu. The comment period closed. Implementation is expected in 2027, and the pitch, I have to admit, is a genuinely good one. Ordinary savers finally getting access to the same assets that sophisticated pension funds have used for decades. Here's what the pitch leaves out. Defaults are rising, and they're rising fast. The headline private credit default rate stayed under 2% for years, which looked fantastic, until researchers started counting what the industry calls liability management exercises. These are quiet restructurings, where lenders absorb real losses without technically triggering a default classification. Once you include those, the true default rate approaches 5%. Jamie Dimon, the CEO of the largest bank in America, warned his own shareholders this year that private credit losses will be higher than expected. His words, not mine, and criticized the industry for lacking what he called rigorous valuation marks. And what that actually means is that these loans are not priced by any market. They are priced by the fund managers who own them, the same managers whose fees depend entirely on those valuations looking healthy. In May 2026, the Financial Stability Board, which is the global body that exists specifically to watch for the kind of systemic risk that blows up the entire financial system, published a report flagging private credit for opacity, leverage, and dangerous interconnection with banks and insurers. So the sequence is record defaults, a warning from the top of American banking, and a global stability watchdog raising flags. And at that exact moment, the door to $12 trillion in American 401k savings swings open. That timing is not a coincidence. And here's the mechanism that most of the coverage on this topic completely misses. Private funds have a structural dependency that doesn't get talked about enough. They need a constant stream of new capital flowing in. New money pays for new deals, supports the valuations on old deals, and gives earlier investors a way to exit their positions. When inflows slow down, the whole engine starts to seize, and the traditional sources, pensions, endowments, insurers, are already tapped out. Many of them are sitting at their allocation ceilings for alternatives and simply cannot add more without breaching their own mandates. Fundraising from institutions has slowed at exactly the moment that older funds are struggling to return cash to investors. The industry doesn't just want new investors right now, it needs them. The last great untapped pool of capital in America is the defined contribution system, which is a fancy way of saying your 401k. Trillions of dollars flowing in automatically from every paycheck, held by ordinary savers who are never going to audit a valuation mark because most people don't even know what a valuation mark is. Now the industry's strongest counterargument is that pensions have used these assets for decades, and that keeping them out of 401ks is basically just paternalism toward ordinary investors. And that's actually a fair point on its face, so let's test it with real data. Americans for Financial Reform and the law firm Angstrom Lee published an analysis of Department of Labor filings covering 58,000 retirement plans over 16 years, from 2009 through 2024. Defined benefit pensions, the plans loaded with alternatives, managed by professionals, returned 7.79% per year. The boring 401k plans holding effectively zero alternatives, mostly plain index funds that a computer runs, returned 9.13% per year. The boring accounts won by 134 basis points annually. Compound that gap over a 30-year career at typical contribution rates, and you're looking at roughly $1.075 million in the index fund account versus around $839,000 in the sophisticated alternatives portfolio. $250,000 difference. And that's the experiment pensions ran with professional staff, institutional level fee negotiations, and experienced people sitting across the table from these fund managers. The proposed fix is to run the same experiment inside your individual account at retail fee layers with less transparency and considerably less negotiating power than any pension fund has ever had. When an industry facing record defaults and stalling institutional inflows suddenly becomes very passionate about your right to access its products, it is worth spending 30 seconds asking who is actually providing liquidity to whom in that arrangement. Step back, and this is really just an old pattern with a new label. When smart money needs an exit, the product gets democratized. It happened with dot-com IPOs in 1999. It happened with crypto lending platforms in 2021. And if the timeline holds, it is going to happen with private assets starting in 2027. It's a legitimate asset class that has made institutions real money in the right environment over the right decade, but asset classes tend to get genuinely dangerous at the exact moment of maximum distribution, when the incentive shifts from finding good deals to finding new buyers. So here is what you can actually do with this information. Sometime in 2027, alternatives are very likely going to start appearing inside target date funds, which are the default option that most people are quietly enrolled in and never actually look at. So look, pull up your plan's fund lineup. If a fund adds a private market sleeve, find out the allocation percentage, the fee structure, and specifically what the liquidity terms are. You are completely allowed to ask your plan sponsor these questions, and almost no one does, which is precisely what the industry is counting on.